This video is an introduction to fiscal policy, or government actions to stabilize the economy. While an economy wants to grow at an average of 3 to 5% per year in GDP growth, there are fluctuations in the business cycle. And Congress and the President are required by law to intervene to stabilize the economy. At the most basic level, we have the Democrats wanted to increase benefit spending, such as unemployment insurance, welfare, Medicare and Medicaid, things like that. And again, at a fundamental level, the Republicans want tax breaks. So we put these two ideas together. Government intervention in the economy is called fiscal policy. There are two tools that Congress and the President can use to fix a troubled economy. They can change taxation, either increase or decrease, and then also increase or decrease government spending. There are two types of economic problems that we deal with, and there are two types of fiscal policy to deal with those problems. The first problem is a recession, characterized by high unemployment and GDP growth that's usually negative. And so in that case, the fiscal policy is expansionary, is necessary to help our economy get out of the recession. The second problem is peak, which is characterized by high inflation. That's the problem, is that prices are rising too fast, your wages aren't increasing as quickly, and so that high inflation needs to be dealt with. And the type of fiscal policy there is called contractionary. So we expand to get out of a recession, we contract to get out of a peak. Within those two types of fiscal policy, starting with expansionary fiscal policy, the way that we'd use the two tools are, we can increase government spending, which increases the government part of aggregate demand, and therefore increasing GDP to create jobs, or to decrease taxes, which gives consumers and businesses more money, and they spend it, adding to consumption or investment spending, and therefore increasing GDP, creating jobs, getting our economy out of a recession. On the opposite end of the spectrum, you have contractionary fiscal policy. And government, in this case, during a peak where there's too high inflation, aggregate demand is too high, they decrease government spending, which decreases the G part of aggregate demand and therefore reducing GDP. And they can increase taxes on consumers and businesses so that with less money in your pockets, you spend less, lowers consumption, and therefore decreases GDP, getting us out of a time of high inflation. Problem number one, recession, an underperforming economy. The graph below shows an underperforming economy well below potential output. Remember, this is the idea of long-run aggregate supply. It goes through the expansion phase or the intermediate phase of the short-run aggregate supply curve. You can go ahead and take a second and pause this and see if you can remember, so you can look back in your notes, what type of fiscal policy is going to be used, and then also what happens to taxes and government spending in this situation. And so in this situation, we'd use expansionary fiscal policy, decrease taxes, increase government spending, and then we can see that our aggregate demand 2 curve now has fixed the economy. We're back to full employment, back to our potential output. The second problem that can arise in an economy is a peak or a time of high inflation. So the graph below shows an economy with a really high price level. So aggregate demand 1 hits the AS curve way out here. So while real GDP is greater than potential output, the problem is that inflation is way too high. So inflation might be 7, 8, 10%. So go ahead and pause it here, see if you can remember what the fiscal policy is going to be, and then also what happens to taxes and government spending. So here's the answer. We have a contractionary fiscal policy. Congress should raise taxes and Congress should decrease government spending, getting aggregate demand back to potential output and getting the price level or inflation back under control. And so here's another look at contractionary fiscal policy. Increasing income taxes so that households will spend less decreases consumption, aggregate demand, and therefore real GDP. All of those fall together. And so fiscal policy is what's called counter-cyclical in nature. During a recession, what Congress tries to do is flatten this out and get us back up to the trend line. So expansionary fiscal policy is implemented to counter a drop in GDP. So therefore, fiscal policy is intended to reduce the severity of economic fluctuations. Fiscal policy was John Maynard Keynes' vision of government planning in order to avoid these economic hardships experienced during the Great Depression, and it's his theory that FDR uses to increase government spending to actually run a deficit, a large deficit as a country, in order to get out of or at least help get out of the Great Depression. However, just like most things, Keynesian fiscal policy is not foolproof, and it does come with some negative consequences, and not every economist believes in Keynes' theories. But Keynes' theory has shaped the American economy ever since the 1930s, when his fiscal policy was put into place, and economists and politicians alike still use Keynesian fiscal policy to help poor economic times.